what we do. Hey guys, we're back with you live on this beautiful Monday morning. And if you're in Ohio or anything in the Midwest up north, yeah, you got hit by a pretty big snowstorm. So that was cool. Lots of fun there. And so the story continues, man. Sam and I have been very busy. We've been putting out a lot of videos, a lot of research. Man, I think we actually got 5 days a week for Gold Rush free, and then Gold Rush Premium had a bunch of stuff. So it was a big week for Gold Rush. And then I had 6 posts this week for my channel, which was on the Substack channel at AAO Research on Substack. So definitely check that out. Put out a lot of good information, including all of our portfolio reviews. Sam, how are you, man?
I'm doing good, Jason. No snow here, unfortunately. I would have liked to get some snow, but it's just been freezing cold, 30, 40 mile an hour winds. It's been brutal. Yesterday, I was watching my alumni, the Wichita State Shockers. They took down number 15 Memphis, who Penny Hardaway is actually the head coach of that team. And the Shockers had lost 10 straight games versus AP top 25 teams. So they hadn't won a game against a ranked opponent since 2021. So it had been about 4 years. So
who was on their team that year in 21? Was that John Morant? Is it? No, he was in the league in 21. So it would have been somebody else. So
yeah, I'm not
remember.
Sure.
It's a while ago, but shout out to Penny Hardaway and the Shockers.
Penny Hardaway is the Memphis coach. Screw him.
I love Penny Hardaway.
We took him down.
So you guys took him down? Yeah. So
it was awesome.
But shout out to the Shockers. Just had to make the Shocker thing. That's exciting for me. Fun times on a Monday. But Penny Hardaway's awesome, man. You can't hate on Penny. Yeah, I get it. You know, you got to root for your team, but Penny Hardaway.
No, Penny's cool. I don't hate him.
I'm excited. He had a career that was amazing, and it would have been a Hall of Fame career. However, he got hurt so much, and then his knee was just destroyed, and then he never was the same again. It just sucked to see because he would have probably been. He'd have been up there. He would have been one of the greats. He was one of the greats for a few years. I mean, he was first team NBA for many years, so it was a good stuff. So
is that who you grew up watching?
Penny, yes. I always wanted to be a big guard, and I just wasn't. So I was always a small guard. So I grew up watching Penny, and then Jordan also.
You were telling me the other day you made 89 out of 100 free throws at the gym.
We're getting there, man. We're getting there. Almost a 90%. One day I'll be at 90%, man. And my jumpers are getting to 70. And this is unguarded, so you don't take that. In the league, people shoot at 50% because they're guarded. I'm unguarded, trying to learn how to shoot better. And so it's been fun, man. Just trying to get the numbers up there, get to that 90% rate. That'd be great. I'm excited about it. I keep working on it, but I keep getting angry that I keep hitting around 88, 89 on my best ones.
Hey, it takes a lot of practice.
It does. It'll take time. So getting into the markets. This week, we've got a bunch of cool stuff for you guys, and Sam and I created a nice slide deck for you guys today. So, starting out with this first chart, and the thing I want to continue to highlight here is the fact that commodities are still crushing it against bonds. So we're looking at bonds here, and we're just seeing that they have been hammered compared to commodities for many years. Because people go, oh, we should own bonds, and let's put some bonds in our portfolio. It'll do great. Sure, you want some short-dated bonds. You want to catch a yield. Fine. You want to buy some long-dated bonds? That's crazy. There's no reason in doing it. I know it looks cheap. It looks fun to do. You can, sure. And I'm not talking from a trading angle. I'm just talking from a long-term angle. Sure, you can. But in an inflationary cycle, this could look more like this going forward. That's the blue line that you're looking at there, the one that just keeps getting beaten down. And after that, it's the NYSE and commodities. And what you're seeing here to start this year, we had this big give back period. And this big give back period, which is the red line, started to give back gains against commodities to start 2025. Good thing Sam has corrected me on my year this year, so I know which year it is. And then going to the top, which is gold to commodities, which Sam pointed this out recently too, which is gold has still continued to hold up very strong compared to commodities, stocks, just about anything. It is ripping, and it is showing the most strength out of all of these asset classes at the moment. So I really like the idea of holding gold. I like the idea of averaging into some commodities. But what we're looking at here in this index is mainly the energy-based commodities, things like oil, gasoline. These are the biggest weighting in this. So the energy commodities haven't been doing very well, but a lot of others have. And so a little bit more of a shorter term view, just looking at commodities to bonds. So looking at commodities to bonds, you're seeing that we're kind of breaking out of this triangle here. So this is an interesting time to just say, hey, you might want to start really looking at the commodities complex. I know bonds look cheap and it looks really fun to buy bonds right now, but it's a hell of a lot cheaper? Commodities. Commodities are ridiculously cheap to everything out there in the market, even though, yes, it had a little run since 2020 and it's had a bit of a move. It's kind of continued that same direction and just to consolidate against bonds. Now it's breaking out, moving higher. We've taken out those old highs from 2023. And if we can kind of continue higher here, I think this will be time where we kind of see inflation kind of come back to rear its ugly head. Now, Sam, you brought this chart of gold. So what are we looking at here?
Yeah, for sure. So we have the gold price in the upper pane going back to 2010. And then in the lower pane, you have the commercial COT positioning in the green. And then in the red, you have the speculator COT positioning. And as you can see, commercials tend to be net short gold futures. That's because a lot of these commercial hedgers are companies like Newmont that have a large mine that they're trying to hedge with these futures contracts. And I've highlighted in yellow the times when the commercial hedgers get close to flipping net long. It's a they aren't carrying much of a position. The spread there between the speculators and commercials is very small, and you can see on the price chart, those yellow circles, whenever that positioning gets tight, tends to be an extremely timely purchase. You tend to make money very fast. And then on the flip side, you can see when commercial hedgers carry extreme net short positions, and that tends to be a pretty good time to look to sell, just from a long-term perspective. It doesn't mean the trend is over by any means, but just from a more tactical point of view, that is a good time to sell. And that is exactly what you're seeing in the gold market right now, is the commercial hedgers are close to carrying a new 52-week high net short position, and they're close to carrying their largest net short position of all time. So I'm not saying the trend for gold is over, but that's not bullish to me to see like the positioning gets so stretched.
It's interesting though, if you think about it a couple different ways. One is, we can't downplay, and I agree with you. However you trade, if you look at the COT reports and you take everything that it says, it is saying exactly what Sam says. So I'm not discounting what Sam is saying. What I am saying is when you look at gold, sometimes the one thing that you have to understand when it's in a massive run is also what's going into this market outside of it. This is one of the markets that spot gold, physical gold, is a big thing. Not all the commodities are like this. This is why the COT reports are great. But it still does tell you something. It's telling you trading wise, the futures market is getting very extended. What could keep this going is China, Russia, countries like that continuing to buy gold. That will continue to move this higher. Also, the physical markets are getting pretty hot again. It's starting to just get on the cover of news, but once again, that's also a contrarian indicator. So there's a couple things here. One is I would never bet against a trend, and Sam said that as well, and I agree with that. You don't bet against a trend, but you also should know, hey, this trend is maybe going to go sideways at some point soon. I would say, we're getting to that zone where it wouldn't be bad for a pause.
For
Sam,
sure.
you had
And it's
some
not like
levels
a
too.
big bearish call, but it's just,
Mhm.
in my opinion, it's bad risk reward for the buyers here.
Yeah,
We
I wouldn't keep
had a
buying
big
it.
move.
Yeah,
So
yeah, yeah. Usually we're talking about whether we would keep buying it, not keep buying it. This is that zone where I agree with Sam. Like I would not keep buying more gold all the way up here. It was a great buy when we talked about buying this pullback. It was a great buy when we talked about buying the breakout of the triangle. Now it's kind of getting a little bit long in the tooth. We're seeing the speculators hit those levels that it hit back when it paused one of the times before this. So I do think there are some reasons here to be cautious on buying more gold, depending on your time frame. Short-term time frame, I wouldn't buy more gold. Long-term time frame, I would say gold is fine. Um, and also, guys, if you guys are checking this out on YouTube, on Twitter, whatever you're on, please feel free to share this, retweet this. It helps get our name out, helps the channel grow. We appreciate your guys' support. So what are we looking at here, Sam?
yeah, so we were just talking about the COT positioning in the gold futures market. But something you haven't seen in the gold's peers, like silver, platinum, palladium, is stretched positioning. It's pretty muted there. I'm looking at the silver market; it's just in the middle of a range, nothing there to see. Palladium, you have the commercial hedgers are just unwinding their largest net long position of all time. So they're close to flat in the futures market right now. But I am watching that market very closely. Once they flip back to net short, I think Palladium's going to be a screaming buy. It could happen this week, this month, this quarter. I don't know, but I think it's coming very soon. Um, what we're looking at here is the equally weighted precious metals index, which is just an equally weighted basket of gold, silver, and platinum. And this just goes to show that the group is working to the upside. It's not just gold. Silver's been flat for quite some time now, but we're seeing broad participation in the precious metal space. So if if you believe, like I do, that gold could be stretched here based on positioning, that doesn't mean you need to run from the precious metals industry, but look for riper opportunities like silver, platinum, and palladium.
No, I like this point here that you're making, Sam. To me, that's what I think the biggest trade right now is this move from like gold's been hot. It's been very hot. It's been the massive outperformer. It makes silver look like crap over the last few years to people. If you just look at the charts now, once again, the returns are nearly the same, but that real silver outperformance, we haven't seen it yet. And something that would say, hey, gold is kind of long in the tooth in this trade at the moment. Gold might slow down and silver might take over. Like what you're laying out here is very timely because we're also looking at the stocks, and a lot of people watch this show and they forget that we're also, when you can forecast where gold is going, where silver is going, and see these trends here, we can also look into these stocks and the gold mining sector and GDX and GDXJ and all these different ETFs out there to take advantage of these markets because these are going to be some massive trades going forward. This could be a move that we haven't seen in many, many years. Gold, like Sam said, gold could slow down. I also think gold will slow down at some point. And then we see silver really outperform. And then we see platinum really outperform and palladium really outperform. This could happen any time now. So this is really good stuff that we're bringing out here from Sam. So silver, speaking of the outperformer, So silver here. Ooh, look at that. Still above the zero line. So what are we looking at here, Sam?
Yeah, like you pointed out, silver is trying to resolve a multi-year base. It's just been churning sideways above a shelf of former highs from the last cycle. And that level was, let's call it $30. If silver is above $30, it's a valid breakout. And the path of least resistance is higher, towards $50. We've been talking about that $50 level. It seems like about every time I'm on your show, we talk about silver reaching that $50 level, and we're talking about it for a good reason. That is probably the best risk to reward opportunity there is in precious metals right now. Getting long silver here at $30 with a target of 50. That's a big move. And as you can see there in the lower pane, also I included the weekly PPO, which is just an intermediate term momentum indicator, and it's just crossing higher right at the zero line, which tends to precede new legs higher and the end of consolidations. So I think silver looks pretty ripe here for a fresh leg higher. I
No, I
like it.
agree. I agree. It looks great, and this is a great chart to just kind of show the risk to reward setup here. Putting a stop under, the support area that Sam labeled here under 29.85. You always want to go a little bit below that, so go to 29.50, 29.60, somewhere around that area, and then you have a stop, and now you're looking at this breakout zone, and it did tap that pretty for a second the other day. So, and that was what, Friday. So once again, this could turn into a big move higher in silver, and we're seeing the momentum is showing up here. It's consolidation. It's breaking to the upside. Huge head and shoulders pattern, even more longer term cup and handle pattern. We talked about that a million times. It's a 50-year breakout that's kind of setting up right now. So this could be another big one. Sam, we were talking about coffee. Sam brought coffee to our attention a long time ago, and coffee had a very similar breakout to silver. And we were just at an event, and somebody said, "Yeah, everybody shares that silver chart. That it can break out and get over 50, and it's a huge cup and handle pattern." And they were kind of discounting it by saying that. And to me, I'm just saying, I've seen that pattern set up a million times, and it has broken out plenty of times within those many times. So once
Well, yeah,
again, it's
people have
a
been talking about the silver cup and handle for a long time, and it hasn't played out. So like they have been wrong, but I think the time is right for this pattern to resolve. Like you were just talking about coffee breaking out of a 50-year base. We saw cocoa just last year or the year before break out of a 50-year base. These are the things you see in commodity super cycles. You see massive ranges resolved and new parabolic uptrends, and these commodities they set new ranges. So
yes.
this resistance that we've seen in coffee for 50 years is going to turn into a new level of support in the future.
No, that's well said. Um, well, one thing I also want to add on that huge cup and handle pattern, which is everybody talks about it not working out, but we haven't filled it out yet. Like people talk about it not working out, but it's like we haven't broken out yet. Like coffee finally broke out of that pattern, and then it moved. And then same with talking about cocoa, it breaks out of the pattern, then it moves. Silver hasn't broken out of that pattern yet. So, it's still building that pattern. And right now, we're really targeting that 49 level pretty quickly. And so if we target that 49 level, consolidate, and then break out, this could be a huge move in the silver market. And so
Definitely,
looking at the
Jason.
seasonality here, great chart here, Sam. We've got some good seasonality coming up. And also, it's bucking the seasonality in February at the moment. So can you explain this one, Sam?
Yeah, so this is just the seasonality for the junior gold mining ETF, GDXJ. Going back the last decade, you can see that this is really the sweet spot to be buying junior gold miners. If you buy the dip in February which we haven't really had. It's up close to 5% in February after a double-digit gain in January. There's some serious momentum behind these junior gold miners right now, and I think it's going to continue into the summer. You can see that April is the best month of the year, and July is also a great month. And then you see some pretty significant selling pressure in the back half of the year, particularly in August and September.
I like this. And a lot of people ask me about seasonality. When I talk about seasonality, I always say one thing is the most important thing to me, which is it bucking the trend? So let's say it's April. Let's say the gold miners are going down. I would say that's bad. That's very bad for gold miners. If it's February or August or September and the gold miners are moving up, it's bucking the seasonal trend as well, which is significant. So, gold continues to make new highs. Gold miners are looking good, more constructive going forward. Silver is starting to have some good performance. I would say that, March and April will probably be pretty significant seasonally speaking. And also, the technicals are all saying the same thing. So I would say we still have more room to run in the precious metals rally. But I think that outperformance is going to start to be in the gold miners and the junior gold miners, as Sam is pointing out here, and in silver and platinum, like Sam said as well.
For sure. And on the technical standpoint, you just mentioned junior gold miners are trying to break out of a multi-decade base. This goes back to 2013. This level has been resistance. You tried to break out in 2020, failed miserably. And here you are back at the scene of the crime. Junior gold miners are trying to break out of a huge base. And I think if they stick the landing here, you could see 78, 79 on the GDXJ within 6 to 12 months. It could happen extremely fast. And once you get that upside momentum, that is hard to stop. You're probably going to see 179, 180, close to new all-time highs in the next few years.
No, I agree. This is a great chart, and this is something that I think we could see going forward as the next move higher. As this moves continues, though, I really think these levels that we're talking about here, like the 179, in the long run, Sam and I always talk about the fact that our targets are going to look low at some point. If you would have talked about $2,000 gold, years ago, what was this, 2015, 2016, that sounded ridiculous. A lot of people thought that was crazy. Now it's like, now we're almost at 3,000. And I think the miners will move even more. Now, once again, they don't really move until we're in a real precious metal cycle. And we really need to see silver start to move to see the juniors really move. And we haven't seen that yet.
I think that's the bull case, Jason.
Yes.
That we've seen this huge move in gold, but we've seen close to nothing from the rest of the industry. You haven't seen silver move. You haven't seen a lot of these gold mining stocks move. So I think
And
that's
yes, Curtis, breaking out. And you guys, please feel free to write in. We love to hear from you guys. But yeah, wheat broke out. We had a buy signal actually last week, so we put it out last week. If you guys check the Substack channel, which is at AAO Research, I put it out for free. Actually, it was one of the free posts last week on Friday. So the wheat is moving.
It's
And
the
it's moving
entire grain space. Like I was even looking at something like rapeseed, which you told me you don't trade because it's not liquid enough, but even that is moving.
all of it is moving, and it's interesting because it's something that we see later in the cycle. It's like this is how these cycles usually move, is gold and the precious metals move, and then everybody goes, look, gold's moving, yeah, but the rest of them, the commodities market's dead. And then next thing you know, the ags start to move, and the softs move first. And we've seen cocoa, we've seen coffee, orange juice. These things have moved like crazy. Yes, lumber needs to catch up. Cotton is looks dead in the water at the moment. but most of the softs have already started to move. Now we're seeing the ags start to move. This is a very significant time in the commodities market. So, we're looking at the gold miners here, and part of it is when you really see that precious metal cycle move. This is where the outperformance is going to be in the precious metals market, but that's also to say that in the grains, we're going to see those start to move. And then now you're looking at precious metals, grains, like you have a nice diversified portfolio of commodities going forward. So that's an exciting time. And speaking of ags, I actually Sam, we put this deck together at the same time, and I literally screenshotted a corn chart, and then Sam put one that looks even better than mine. So I just said, okay, we'll just keep Sam's chart. But I wanted to talk about corn too because this is significant. This is a huge move that people are just like, yeah, it's fine. Nothing's going on in the
Nobody
commodity
really cares.
space. Yeah, it's been a huge move, so far this year. So, explain the commercial hedger position because that as that unwind is happening, we're seeing that move. So, what are we seeing here, Sam?
Yeah, for sure. So I was mentioning earlier the commercial hedgers have been net long palladium futures, and they have held their largest position of all time from a net long perspective. And it's the same thing here in corn futures. Whenever you see them flip from that net long position to a net short position, that is an incredible time to buy. And you saw that in 2020. If you bought the breakout whenever the commercial hedgers flipped back to a net short position, you made close to 100% in about a year with minimal drawdown too. If you look at that uptrend from 2020, 2021. And then here you are in 2024, late 2024. I think it was around November or maybe before that. I don't have the data in front of me. But anyways, commercial hedgers flipped back to a net short position. And sure enough, since they've done that, you've seen corn futures absolutely scream higher. Back to this key level of interest, $500 is the line in the sand. You saw it act as support in the prior cycle. It was flipped into resistance in late 2023. So if corn futures can get above 500, I think you're looking at a pretty quick move back up towards that 2022 peak, close to $800. That's a pretty big move. I don't think enough people are talking about this.
Yeah, and it's funny because it's one of those things like we got the buy signal for it. Nobody. It's funny because I talked to people in the conference call just last week. Nobody took that trade just because it was so dead in the water. Nobody even cared, But it's to me, it's when it's a buy signal, I'll take it. I don't care what it is. So I get a buy signal in corn. Great, we're gonna take it. And that's kind of how you have to look at trading generally. Like this is a good trading lesson because yes, everybody wants to focus on being right. But if you're losing 1% of your portfolio to gain 5% of your portfolio and you set up your risk to reward properly, you can take lots of shots at trades. One trade getting stopped out shouldn't kill you. So once again, we've gotten one buy signal in corn in years. And so we finally get the second one, and now it's just taking off like crazy. And so most of the time, like every time I say like, hey, I'm going to take a trade that I really have like it's been rough, it's dealt with a couple losers. I always say that most of the time that's where my biggest winners come from. Paul Tudor Jones said it best, in Market Wizards when he talks about people. It doesn't sound as because people be like, yeah, you shorted the top of the market, and Paul Tudor Jones shorted the Nikkei Stock Exchange right at the top, and all these things. And he's like, yeah, it doesn't sound as cool to say Paul Tudor Jones on his fifth attempt has shorted the top of the Japanese stock market. It sounds way cooler to say Paul Tudor Jones has shorted the Japanese stock market and nailed it. And that's the truth of all of our trading is if you're a good trader. And there's an analysis, speculation, and then there's trading. So if you want to be a good trader, that really comes down to the ability to take shots again and again, set up your risk to reward properly, and understand your big picture view. And what Sam's laying out here is the big picture view that corn is flipping to a net short position. and you should take that buy signal when it comes. And if you didn't, there's another buy signal up here where you could take a secondary one above 500. So once again, these are big moves that do happen in the commodities markets. So here's a more tactical view. So what are we seeing here, Sam?
Yeah, so we've gotten the breakout above that May peak, and we've flipped that former resistance into support. And here you are in a tight consolidation. I could have included some Bollinger Bandwidth on here. I did not, but you're seeing the volatility compression. And from there, I'm expecting to see volatility expansion. I think it's going to be to the upside. I think you have a clear level to trade against there. It's 496.5. And from there, I think you can target that Fibonacci extension level I included on the chart at around 531.5. And ultimately, I think this will end up at 620. I was talking about $800 corn earlier. Like that's close to where it peaked out in 2022. I don't think that's off the table, but this is just a much more tactical look at it.
So we got a question here, which is asking us our thoughts on EEM over wheat or corn moves. I think he's meaning the emerging markets ETF, and which is stronger in your opinion. So once again, here's the thing about markets that I think is very important. Number one, nobody knows the future. Because nobody knows the future, to say I'm going to take this, I have, let's put it the way it is. I have buy signals in, and which is true, emerging markets, wheat and corn. And so, yes, he said that's correct. So it is the emerging markets ETF. So let's say I have buy signals in all three. Take all three trades. That's the easiest way to do this. Now, wheat and corn are highly correlated. So once again, I would go, okay, I'm going to take a little bit smaller positions in wheat and corn just because they're so highly correlated. But emerging markets, like I would just have in there too, because once again, you don't know the future. Emerging markets could be the massive outperformer this year. Wheat could be the massive outperformer this year. Corn could continue to be the outperformer. I don't know which one is which yet. And so the way I always trade is I take all three trades as the signals come. The way you do this to set it up in like a trend following style portfolio like mine is you find all the tickers that you're going to trade. Yes, based on capital, you can create limits of how many signals you're willing to take. So you would go, okay, I'm watching 100 tickers. I take up to 20 trades at a time. And so each time you get a signal, you would just put the trade on. So all three of these would be in that portfolio on that, and if that's the case. And because nobody knows what the future holds. I wish I did. I would stop trading things that are so highly correlated, like heating oil, gasoline, and oil. They're so highly correlated, but there's been times in history where heating oil's been the massive outperformer and oil's gone nowhere. Same with gasoline, same with oil. So once again, taking all the trades is the easiest way to do things like that.
I think that's a good answer. And last Tuesday, we went live on the Stock Market Media YouTube channel to talk about the implications of a weaker US dollar. And we primarily stuck to commodities, which we think there's a ton of opportunities there, not just precious metals or grains, but just the entire commodities complex. But something we didn't talk about was emerging markets and emerging market currencies. If the dollar is going to be weakening here, like we think it is, emerging market currencies and emerging market stocks are going to be ripping. So I think it's just a long-winded way of saying I agree with you. Take all the signals, like they're all going to work.
You have to take them all, and that's the what Sam said is significant. If you guys check out my Twitter, you'll see I reposted that thing or the call that Sam and I went on a bunch. I reposted it on our Substack as well. I'll repost it once again on YouTube once I get done with this. But no, I agree. I think there's once again, it's all the same trade. And that's what I say this so much. I probably sound ridiculous to some people because people would be like, well, the fundamentals and this and that. No, if you're looking at a weak dollar market, this is the thing that people don't understand when they say, oh, emerging markets have been crap for years. It will continue to be crap. Yes, it's been crap in the years that the dollar has moved up. Emerging markets have been great investments in the years where the dollar is getting hit. So once again, we have to figure out how we're going to play the cycle. And the cycle is looking like a weak dollar cycle where the commodities are going to start to move, where we're going to see emerging markets and different countries start to outperform for once again. Europe is even outperforming. So it could be an interesting time going forward to just buy some of these things and really have that outperformance. I think that's a thing that people don't understand, which is when you're a trader, it's very easy to say, I'm going to buy the cues. Like once again, trading is different than being a long-term investor. If you're being a long-term investor and you're like, I'm just going to buy the cues, and you're just like, okay, well, why? Well, the cues will outperform every single year. That's not true. There's been plenty of years, even in this bull cycle, where the US has been killing everybody else, where other countries have outperformed. I remember 2019 being the clear year where we had massive outperformance that year in the fund. And the reason was, and this was like back, we were trading Russia, we were buying Greece. Brazil was an outperformer that year. So there was like, I can remember that clearly. And also the cycle was very different. It was a cycle where consumer staples were an outperformer that year, utilities and bonds. So
Not a lot of tech stocks in Russia.
No. So when you look at that, it just as a whole and just go, okay, well, that was a very recent year where we had some of these countries outperforming, where we had like weird sectors outperforming. Think of 21. You had energy as the massive outperformer, and also some of these other countries actually started to do really well that year as well. And also we have buy signals in Chile and Colombia, in Brazil. So these just kind of continue to come down the pipe as like, hey, there's something going on here that's significant. And I think what's building is a weak dollar cycle. And so a couple quick charts before we go. One is the NASDAQ to the small cap index. So SML, which is just the small cap 600 index. So when we look at this chart, what I'm pointing to here is, people point to the dot-com bubble and go, okay, well, this is going to look exactly like that. I don't think so. What I do think is this year, or maybe the coming years, will look very similar to what we saw at the end of 2020 through 2021. And what happened those years was right during the election, the NASDAQ started to massively underperform small caps. And you wanted to be in small caps, you wanted to be in financials, you wanted to be in energy. This is the areas that were massively outperforming the market. The regional banks were massively outperforming the market. I think this year is going to look similar. We saw that thrust happen in July of 2024. Now we're kind of reaching those zones again. I don't think it's going to hit that zone just right. I'm pretty sure this is going to turn back over. And the reason why I'm saying that is looking at the underlying sectors that are doing well, looking how the Mag 7 is massively underperforming. If you look at the rest of the S&P 500, if you minus the Mag 7 from the S&P 500, the S&P 500, or call it the S&P 493, is actually up 5%. It's up over 5%. And the Mag 7 stocks aren't even up 1% to start this year to date. So once again, we are seeing this rotation. Like you said, Italy, the optionist mentioned that Italy has been great so far. Yes, we're seeing Italy. We're seeing all of these areas that we just haven't seen in many, many years start to look really good. So it's exciting. And once again, that's how I feel like more people should feel about this. People are like, oh my gosh, you're talking about this, that, and the other thing, and this is dead and tech is dead. It's like, no, get excited because there's other things happening out there and you don't have to just invest in the United States forever. Like that's kind of been the game, is like, for even me, like, hey, we got to be long the Q. The last couple of years has been, hey, we got to be long the Qs. That's been our massive outperformer, semiconductors and so on. This could be an area where now we're seeing something else different happen. And so this chart, Sam, wanted to ask you this because you've been talking about copper a lot. And copper looks really interesting. It's hitting a 150-day high now. It hit a 50-day high. I posted about that. then a 100-day high, now a 150-day high, 52-week high is probably coming pretty soon. So
All-time highs.
what do we think about copper?
I think it's going to new all-time highs. I think you can overlay copper with gold going back decades, and they're close to the same exact chart. We've seen gold break out of a multi-decade base. It's hit several of our Fibonacci extension levels. The breakout is more than solidified. I would be so shocked if gold went back and failed this breakout. With that context, you want to bet on copper following gold's lead and breaking out to new all-time highs. It has a gorgeous head and shoulders continuation pattern on the more short-term time frame. And then if you zoom out to the Great Financial Crisis, you can see a giant multi-decade base there. So you have the technical setup. It would make a ton of sense to see that just from the technicals. And then if you want to get fundamental, you have China as one of the largest consumers of copper in the entire world. And that is one of the things we've been talking about most at All-Star Charts. And between you and I as well, China is just
China's been hot.
China's
We've been talking about it a
so hot.
lot.
And
Yeah.
if China's hot, do you really want to bet on copper not participating to the upside? I think that is crazy. So I just think it's a matter of time before copper breaks out above this $5 level and makes new all-time highs, and probably talking about $7, $8 copper by the end of the year.
No, I love the way you said that, because if we're looking at copper, copper always follows. Copper likes to follow gold. And the way the commodity cycle works, it's just something that always tends to happen. Gold starts to move. We always talk about gold rings a dinner bell. That's the truth. So gold breaks out shortly after that, or not shortly after that, about 10 months to 14 months after that, then copper starts to move. So, to me, I think that this is a massive move that's going to happen here in copper. I think it's going to catch up to that 10-year yield at some point as well. If you guys hear the dogs, sorry about that. They have a tendency of going nuts from time to time because, they're dogs.
The mailman must be there.
You never know, man. You never know. Or the milkman. You never know. It gets weird over here sometimes, guys. Bear with me. So here's a coffee chart. And so I brought this. This is not as far back as, we had one that Sam brought here, which goes back even further. But just
1977 was the ultimate peak.
Yes. So even going, like, once again, it's depending on the data. I have a chart from TradingView, but I was kind of getting this together a little bit late. So sorry about that, guys. I'm slacking. But basically just kind of showing you those highs. And that's the zone even going back to 77 that we did kind of stop at. Now, look at this chart and then think back to what we talked about silver. Do you want to make the bet that silver can't do what cocoa, coffee, and these other things do? That's fine, but I do think that there's something to be said about having that view in your head. And this is a thing that I don't think I've ever talked about much, but I think it's very true, which is if you want to trade well, you have to have a couple things. Like, yes, you have to have that conviction. Like, people always talk about conviction. And really, I think conviction should be in your strategy or systematic method, however it is. But also, I think you have to be able to have a view in your head of what the future might look like, just to hold on to these trades properly. Like, you're looking at a breakout here. Like, if I didn't think that this was possible, I would probably bypass my own systems. I would go, okay, it's impossible. Can't break out here. These things could happen. Here's the fundamental reasons. Here's the technical reasons. I could make up a billion reasons why something can't happen. But I also want to think about the reasons that it can happen. So, thinking about Peter Brandt said it best, which is strong opinions weakly held. And so I want to have a strong opinion that this breakout will happen, that silver can possibly get up to those zones. But I also want to have a nice trailing stop and a nice position size so I don't get killed, because coffee futures are pretty big contracts.
I think that's very well said, Jason. Isn't it like 100 grand for one coffee contract right now?
Yes, they're over 100 grand actually. Hold on, I will give
That's
you
absurd.
the exact number, because I feel like it's like the last I looked it was like 140 or something, which would make sense. Let's see. Just so I can say exactly what it is at this point. 137K per contract.
That's insane.
So they just keep getting bigger. When I first started trading futures, they were a big volatile contract for me and the size of my portfolio at the time. So if I looked at the contract size, I think it was like 25 or 30K at that time. This is going back to 2016. So it's a pretty small contract at this time. It's nothing that crazy, and it's right when I started to have the size to trade something as big as coffee. Now, once again, the years go on, portfolios grow, and now we're trading coffee at $137,000. It's wild. Okay, so we'll end on this question. So why should the bigger the base, the higher the space work? What is the fundamental explanation behind this idea? Sam, you might actually have a better answer to this than me. So you go first, because you have taken the CMT stuff and I have not.
I don't have a good explanation for it. To be honest with you, I've just seen it time and time and time again. I'm a market historian. I've looked at all of the best bull markets of all time, and a lot of these uptrends begin with massive base breakouts, and I think it could be tied to some type of volatility expansion, kind of like your Bollinger bandwidth. You have this extended period of volatility compression, and then you get the breakout and volatility expands, and in this case it expands to the upside. So if we're looking at a 50-year base of coffee, just imagine coffee's done absolutely nothing for 50 years, and it breaks out above that shelf of former highs, and then the volatility expands to the upside. And it's pretty much exactly what we saw with cocoa. It was a parabolic uptrend. You see those all the time with these massive base breakouts. And you've even seen it with Abercrombie and Fitch recently. This super strange. Like, you'd never expect something like Abercrombie and Fitch to be in a parabolic uptrend. Like, that is just crazy to me. But sure enough, it broke out of a huge base and it went up a lot. So I don't have a good explanation for why bigger the base, the higher in space works, but it sure as hell does.
It sure as hell does. There's some interesting things about it. One is when you look at just this chart, what is up there for price memory to say, hey, like, because that's a thing. Like, we want to talk about fundamentals all the time, but really the market's psychological. Sometimes there's no real reason for coffee to be all the way up here. Sometimes there wasn't like where cocoa went to. I couldn't have given, nobody in the world before that happened could have given you a fundamental reason for why cocoa went up so much. People tried to say it in hindsight, but to me it was just, hey, it's baking out of a big base. That's as simple as it is. But if you look at it, if it's a psychological thing, then where does price stop? There's nothing up here for people to look at and say, hey, I would like to stop here. The demand is up here. This is a supply zone. Like, there's nothing like that up here. It just can continue. And there's no resistance. There's nothing for it to hit. And so really, when you just look at it that way, it's okay. It's simple to understand. But then also think about back tests. If you back test things, you find out that when you hit new highs, things have a tendency to continue. Also, there's a great back test of people buying the S&P at new all-time highs or trying to buy dips. And they find out that just buying at new all-time highs, they make more money than trying to buy dips all the time. There's a bunch of interesting information about this stuff. But once again, when you look at it, I think it's also, and this is more of a philosophical view, it's the market's way of rewarding people who actually take that risk. Normal people, they want to buy dips. Let's be honest. When we all start trading, everybody thinks the idea is to buy low, sell high. Nobody tells you that the real idea is to buy high and sell higher. So you would think it's buy low, sell high. So as these breakouts happen, and as we get out of these major zones, and that's why when you look at mean reversion trading, which is where you see pullbacks happen and people buy them, it doesn't work very well in commodities. It doesn't work very well for big returns even, but it can work in equities here and there. And so when you look at it a bunch of different ways, okay, commodities tend to trend big in big ways. The breakouts tend to continue in big ways. The most successful traders in history buy 100-day highs, 150, 200-day, 52-week highs. And that could be fundamental stock guys all the way to just trend following systematic traders. A lot of them talk about 52-week highs. So most of the time people don't buy lows. So once again, are you trading or are you long-term investing? Long-term investing, sure, you can try to find something of value, buy it at a very low level. Trading, you want the momentum behind it. How do you get momentum behind something? Well, you buy it at new highs, and new all-time highs are where the most momentum is every single time. So I hope that cleared that up. Also the optionist, he's a good trader too. He's always talking to me about good stuff. New price has to form as supply and demand changes over time. Yes, exactly. So, it's understanding technicals will help you to understand why they work, because we're not just people who look at price and go, that's the way everything's going. It's what the market is telling people voting inside of the market. Do you want to bet against a bunch of people who are saying, coffee's going to go higher just because you feel like it shouldn't? Most of the time, no. So there's a bunch of reasons there. So we could make a whole show on that, honestly. I'm
Yeah,
just going to shut
it's a
up because I
fascinating
could
topic.
go on forever. But I'm so glad you brought up that topic. Thank you for bringing that up. We'll see you guys next week. Same time, same place. So we're on every week at 11 a.m. Eastern time. And then now Sam and I are going to get on the Gold Rush show. So we're going to see you guys there in a little bit.